Hello, and welcome to Morgan Franklin Fellowship's Back to Basics, Improving Your Financial Capability workshop. My name is Tori Barabee, and I am the Director of Marketing and Outreach for MFF, as we like to call ourselves. And today I am joined by our Director of Education, my friend, Dr. Jillian Starman. Hi, Jillian.
Hi, Tori.
We are pleased to present this quick information-packed webinar as part of a nationwide celebration of April being National Financial Literacy Month. The goal of this month's campaign is to highlight the importance of financial literacy and to teach and remind citizens how to establish and maintain good, healthy financial habits. Just a few words about Morgan Franklin Fellowship before I turn the webinar over to Jillian. At Morgan Franklin Fellowship, we believe learning how to talk about money and understanding how money works in the real world are the first steps in recognizing an individual's financial goals. We believe everyone should have the opportunity to become financially independent. At the end of today's program, we'll share a little bit more about our organization, but for now, let's get started. So what are we going to cover today? Well, does thinking about your personal finances overwhelm you? Does it make you nervous? Does it make you anxious? Are you ready to push the reset button and make a plan to improve your financial picture? Knowing that knowledge is power, today we are going to look at credit scores and what they are, how they impact your ability to get credit, and how you can improve your credit score. We're also going to take a quick look at credit reports and what they are, and again, why are they important to you to periodically review and understand what's on them. We're going to talk a little bit about emergency funds and why it's a good thing to have one or maybe two financial emergency funds if you're planning on keeping your finances under control. And these are all things that will help empower you when it comes to thinking about your personal finances. Let's begin by talking about credit scores. So take it away, Dr. Jillian.
Thank you, Tori. So the first thing we're going to take a look at here today is your credit score, and knowing what it is, what makes up your credit score, and how you find this are all important things. One of the things that a credit score is also known by is FICO score, and that is FICO, and that stands for the Fair Isaac Company score. So you may hear it referred to as a credit score, and you may also hear it referred to as a FICO score. But this basically is a quick snapshot of how you manage your credit. It's a 3-digit number, and this tells people who are lending you money what type of risk you are. And so, for example, you'll notice on the slide here, we've got all these different numbers in the graphic, but they range from 300, which is a very low score, to 850, which is a perfect score. And very few people are in the perfect score range, but being in a higher range means that you are a lower risk borrower. If you're in a lower number risk, say between 300 to 500, you are a higher risk borrower. And there are certain things that go along with this that lets the bank know. So they're looking at the types of credit that you have. How long have you had credit? If you've only had credit for 6 months versus if you've had credit for 6 years. And what are the credit limits you're using? So if you've got all of your credit cards maxed out, that doesn't look very good on your credit score. And it also means that you are at potential risk for defaulting on any of the loans that you have. And the debt level that you have. They're looking at that to make up part of this number, as well as payment history. So if you've made your payments on time, that helps increase your score. If you've made a lot of late payments, then that will decrease your score. So these are the important things that we need to look at when we're looking at credit score. So let's move on to the next slide and take a look at how credit score is calculated. So we just talked about some things here in that previous slide. So here's the percentages now of what makes up your credit score or your FICO score. So 35% of the score is made up on your payment history. So if you have made, like I said, if you've made your payments on time, that'll improve your score. If you've got late payments, then it's going to kind of put a ding in your score. So you need to make sure that all of your bills are paid on time. And how much you owe. If you have a credit balance or credit that's available to you of, let's say, $10,000 total, then you should only have about 30% of that being used. So that means that if you've got $10,000 in credit available to you, you should only owe 3,000. And that means you have 7,000 available. That there is the amount owed. And 30% of your credit score is based on that particular number. Your credit history, how long you've had credit cards open, how long you've had your utilities open. So even paying things like electric bills or water and sewer bills, or your cell phone bill all gets reported to the credit reporting agencies, and they look at your credit history. How good are you? And that, of course, makes up 15%. New credit makes up 10%. So for example, say you go to the mall and you go into a store and they offer you a store card, a store credit card. If you open up a lot of new cards at once, then that will reduce your score, because that means that you're opening up a lot of new credit and you don't want to do that. Opening up one here or there periodically doesn't seem to matter, but if you're doing too much at once, it does. And then they want to look at your credit mix, and that also makes up 10%. So if you have, say, a car loan, and then you have utility loans, and then you have a credit card, those are different types of credit. Now, I'm not saying that you need one of each, but they look at what the mix of it is. So if you have only certain types, and you haven't got, say, for example, you've never bought a car, or maybe you've never had a credit card and you've only paid utility bills. So those all make a difference in how your credit score is calculated. So let's take a look now at what you can do to improve your credit score. So I think we've said now several slides recording paying bills. And so if you pay your bills on time, one of the best ways to do that is to schedule it. So if you have a phone with a calendar, make sure that you put it in as an appointment in your calendar to pay your bill at least a day or two before it's due, and that way you won't miss the date. Sometimes bills have grace periods, and if you get it paid before the end of the grace period, but you need to make sure. If, for example, you have a bill that is due on the 15th, but you don't get paid till the 20th, then you could probably contact whoever owns your credit and talk to them about maybe changing the date that your bill is due so that you're not late on it. Make sure that you read your credit card statements each month and know where your balances are. It's important. Just because your credit card says you have $10,000 doesn't mean you should max that out. You should always keep your balances low. And remember that whenever you charge anything on a credit card, if you do not pay the balance off in full at the end of every month, you will be charged interest on that. So if you bought something for $100 and you don't pay it off, then whatever the interest charge is will be added to that the next month. So say you only pay $20, then $80 will end up with a charge on it. So the thing that you bought is going to cost you more. So make sure that you keep those balances low. And like I just talked about in the previous slide about opening new accounts, don't open too many new accounts at once. Sometimes this can happen around the holidays. You'll go shopping and people will just be offering you cards. It is okay to say no. You don't need one, you have enough. And so don't open too many cards at once. And the other thing, which I kind of learned the hard way, is that you don't want to close out old or unused accounts, because one of those numbers that we looked at in what makes up your credit score was how much credit that you have. So if I have a credit card that has $5,000 limit on it and I close it, that means that my overall credit has now been reduced by $5,000. So it's okay to have a card and not use it, but it's especially if you're looking to use up your credit score to use it for something, you really don't want to close it out. Just make sure that it sits there and that you don't use it. So now I'm going to turn it over to Tori, and she's going to tell you about a credit report.
Thanks, Jillian. I was just thinking as you were going through these tips, and paying bills on time is so important. And when you think about the amount or the proportion of what dictates your credit score, when 35% of your FICO score is based on paying your bills on time. And I love the tip about don't open up too many accounts at the same time. And you're right, when you think about every time you're in a retail store and they always say to you, would you like to open up an XYZ credit card and receive 20% off today? And that sounds so enticing. But then you come to realize you have a lot of credit cards that you really aren't using, and you may have opened them all at a time and done yourself a disservice by opening them all at the same time. So great tips. All right, so let's talk a little bit about credit reports. So Jillian talked about credit scores, and I like to think of credit scores as being the equivalent of a GPA, your grade point average, while your credit report is your actual academic transcript, showing a lot more detail and information than your 3-digit credit score. In reality, your credit score is calculated based on the information that appears in your credit report. So, what is a credit report? Well, it's a statement that has information about your credit activity, and that's all your credit activity, and the current credit situation, such as that loan paying status that we talked about, and the status of your credit accounts. Are they in good standing with your creditor? This information is sent from your creditors to 3 credit reporting agencies who compile it into their agency's credit report for you to review or for them to review on a monthly basis. So what kinds of information is being tracked on you? We'll talk about that in a second, but understand that back to those credit reporting agencies, there are 3 nationwide credit reporting agencies: TransUnion, Equifax, and Experian. And you've probably seen ads for each of them on TV. Here in the Northeast, where I am, TransUnion is considered to be the most comprehensive credit reporting agency. So that means they are the largest agency here in the Northeast that takes all of our Northeast residents' consumer information and compiles it into your credit report. Jillian, you're joining me today from the Midwest, and I think your largest credit reporting agency is Equifax. Is that correct?
That's correct.
Okay. So when somebody is pulling a credit report on me, they are most likely pulling a TransUnion report because that's going to have the most information and the most current information on it about me. But if you're in the Midwest, like Jillian is, chances are creditors are looking at your Equifax report to get the most current information. So who's reporting information on your credit report? Well, think about mortgages, credit cards, utilities, like Jillian mentioned earlier, car loans, student loans, companies who have lent you money or are providing you a service and billing you for that service. What are they providing information on? Well, they're providing your personal information. So your name, and any other name that you may have used in the past in connection with that credit account. So if you were Susie Smith and you had an account with your electric utility and you got married and now you are Susie Martin, your credit utility may be reporting you as Susie Smith on your credit report. It's really tied most importantly to your social security number. So that's going to kind of follow you wherever you go. But they will list your name, your current and former addresses. So if you lived 3 houses ago and you had credit extended to you from a local utility or a credit card, all of that information is going to be provided on a credit report. Your birth date, your social security number, as I mentioned, and any phone numbers that might be associated with you. And that does include old landlines. It includes cell phone. And in some instances, people who use, somewhere along the line, you may have used an employer's phone number on a credit application. That too may appear on a credit report. It shows your credit history. So this is really the important piece, where it shows what type of an account you had with each creditor, and it shows what types of things you are. It shows things like your account balance, your account payment history, the date that the account was opened and closed, if it was closed, and the name of the creditor. So it will also include if you are on an account with someone else. So for instance, if you have a student loan and a parent or guardian or relative is a co-signer on that loan, or a car loan with someone who's a co-signer, a spouse perhaps, or a parent, their information will appear in that credit history portion of your credit report. Any collection information about you, so any liens, foreclosures, bankruptcies, or civil judgments, any public records about you will also appear on a credit report. And any inquiries by employers, possible creditors, banks are listed. And you might wonder, well, why is that? Why would my employer be pulling my credit report? And we'll talk about that in just a moment. So how are credit reports used? When you apply for credit, lenders will pull your credit report from whichever credit reporting agency they use. And that's that TransUnion, Equifax, or Experian I mentioned earlier. The lender will then use this report to help them decide if they will loan you money, what interest rates they will offer you, and anything else that they need to determine. Lenders also use your credit report to determine whether you continue to meet the terms of an existing credit account. So very important information that lenders will use to determine if they will be extending you credit or continuing to extend you credit. Other businesses might use your credit reports to determine whether to offer you insurance, to rent a house or an apartment, to provide you with cable, internet, utilities, or cell phone service. The employer that's noted here, if you agree to let a potential employer look at your credit report as part of the application process, it may also be used to make employment decisions about you. For instance, I worked for an organization in the financial services industry, and if you had defaulted on a loan within our industry, you were not eligible for employment with us. So there's a few tips on how to improve your credit report and where to get your credit report. All of those tips that Jillian mentioned earlier about paying on time and keeping your balances low and not applying for credit quickly, and closing out unused accounts, all really the same information and tips on making sure that you maintain a solid credit report. You might wonder, how do I get a credit report? Well, every American has the right to receive, under federal law, a free copy of their credit report each year from each of those three credit reporting agencies. So at annualcreditreport.com, you can request a credit report from TransUnion, from Experian, and Equifax each year. During the COVID-19 pandemic, that has been extended, allowing American citizens, US citizens, to actually receive credit reports weekly from each of those three credit reporting agencies. So why do you want to do that? Well, it shows you what's being reported about you and what's being said about your use of credit. And it also allows for you to check your credit report for errors, for fraud, and for possible cases of identity theft. And a great example of this that I like to share is that I have a friend who pulled her credit report, and on it was an account with Banana Republic. And she never had a credit card with Banana Republic that had actually been sent on to collections. So she was able to report to her credit reporting agency that that was a fraudulent account, and they researched it and took it off of her credit report, which then not only improved her credit report, but it improved her credit score. These are all great things to know about your credit report. And we're going to turn it back to Jillian, who's going to talk with you a little bit about the importance of having emergency savings funds.
Thank you.
Jillian.
Thank you, Tori. And some of the reasons why people get into trouble with a low credit score and a bad credit report is because they don't have money saved to purchase the things that they want, and they're always using credit for it. And so the reason why we're talking about savings in this particular section is that because if you do have savings set aside, then you're not using credit for everything that you're doing. Now, there's nothing wrong with using credit for maybe all of your monthly expenses, and then you pay it off at the end of the month, knowing that you have the money there. But making sure that you have a budget in place, and that in that budget you have money set aside for certain things is important. 40% of Americans, it has been found, can struggle coming up with $400,000 to pay an unexpected bill. So is that a visit to the doctor? Is that you need a new tire on your car? What does that mean? And so emergency funds are there for a reason. They're there to cover unexpected or unplanned expenses. Having money there gives you financial stability. And I share the story of how I was sitting in my office one day and heard a noise in the garage and didn't know what it was until I went to move my car and my garage door didn't open. And so I had to call in a technician to come and fix it. That was unplanned. I hadn't planned for my garage door to break. But because I had an emergency fund, I could take the money out of that fund to pay that bill. But then, of course, you have to make sure that you replenish that emergency fund once you take money out of it. So it didn't stress me that I had to pay for this unplanned expense because I already had money set aside to do it. And that's one of the biggest things is that when people don't have money to pay things, it causes a lot of stress. And having funds set aside is something that you can do to lower that. Having an emergency fund is also a way to avoid making bad decisions, because by putting the money there, you know that it's there for a reason. Are you saving for a vacation? Are you saving to buy a new car? Are you saving to buy something that you've wanted for a long time? Are you saving for a down payment for a house? for example, if you have 4 different things that you want to save for, you're going to put different amounts of money in each account. Have a separate account for them, and put that money there so it's separate from anything that you touch, or anything that you're paying on a regular basis, through your budget. So let's take a look at some tips, for how you can build your emergency fund.
Jillian, just before we bounce off of this slide to the next one, I did want to make one small correction to something that you said. And you cited a study that we love to talk about where it's been reported that 40% of Americans could not cover a $400 unplanned expense. You kind of added a few extra zeros when you said it. And it wasn't a $400,000 expense. It was as small as a $400 expense that 40% of Americans said that they would have trouble covering the cost of that. So just to allude to why savings funds for emergencies are so important.
They really are, yes. And so one of the things that you need to do if you've never tried to save before, start small. One of the things that we talk about in our course on financial literacy is that if you even do something as small as putting $2 away each month, and you don't touch that, it will build up over time and you can save money. Um, it used to be that people used cash and they had change at the end of the day. There were a lot of people that would take that change out of their pocket and put it in the jar at the end of the day. There are apps that you can use on your phone now where you can pay for something and you can round it up. So if the thing that you're buying is $1.85, you can round it up to $2, and that extra money then goes into a savings account. And you do that over a period of time, and you'll be surprised how the small pieces will add up. Another thing you can do is automate your savings. So for example, if you have a check that comes in every month and your check is, let's just make a number up, $1,200. If you take 10%, which is $120, and you put it in a savings account, you're automating it every month. And so that money is going automatically from wherever your check comes into a savings account. Now, if you can't afford that, find another number, put something, but make sure you put something in there every month. And we've kind of talked about saving your change, but whatever that means to you, how are you saving these small pieces and how they're adding up? It's income tax time. Are you saving your income tax refund for something? There are a lot of people that wait to buy certain bigger items until their refund comes in. But maybe if you put that refund into a savings account that is earning interest, you could actually make that money make its own money. And so those types of things are very helpful too. And like I mentioned before, if you can separate your savings into different accounts, you've got one account that you're saving for a car, one account that you're saving for a vacation. Maybe you have another account where you're saving for, say, holiday and gift giving, because a lot of times when the holidays come around, people tend to spend money that they don't have and then spend the next, I don't know, 6 to 8 months paying off those expenses. So plan ahead, have money where it needs to be, so that you have this money set aside for a specific purpose and you can use it instead of going into debt for it. Now let's take a look at some other expenses that you can plan for. And I think this is one of the biggest things that people kind of stumble over, is when things happen and they don't expect it. Now, I mentioned my garage door and how I had to, that was unexpected. This year, I have to replace the roof on my house. Usually roofs will last anywhere, depending on the material, from 15 to 25 years. Mine's going to be 22 years old this year, and it's starting to look its age. So I've been putting money away to repair my roof. Now, had, say, a storm come through and ripped it off, then maybe my insurance would pay for it or some of it. But unfortunately, it's just age and it's something that I have to set aside in owning a home. Car repair and maintenance. When you have insurance, it repays for some things if you're in an accident. But say you backed up accidentally and hit a pole in the parking area at a grocery store or mall. It was an accident and you have a deductible. Do you have money set aside for that deductible? Um, Going on vacation. Do you save to go on vacation or put your vacation on credit and then pay for it afterwards? It's always cheaper and better if you can save for it rather than paying for it later. Because, like I mentioned before, if you put it on credit, it's going to cost you money more if you don't pay it off at the end of the month, and you're going to get that interest on it. And like we just talked about in our tips for building emergency funds, if you've got holidays and stuff coming up, make sure that you have the money set aside to do it and you don't go into debt to buy gifts or things for other people. So getting money somewhere, like in a savings account, or even if you're not going to need it for several months, you can put it in a CD that earns a little bit more interest. But putting the money somewhere where you can't get to it easily is advisable, but making sure that you're planning. And that's why we call them emergencies, because you can't plan an emergency, it just happens. So make sure that you're putting your money away, you're being thoughtful about what you're doing with it. So I'm going to turn it back over to Tori, and we're going to talk a little bit about why all this matters.
So why does all of this matter? So establishing that positive credit history and understanding what is on your credit report, what's in your credit score, and also having some emergency savings set aside. Well, there's a couple of really great benefits. It saves you money in the long term because you won't have late fees, and it provides you the benefit of better interest rates on any new credit that you may request. I love that Jillian's analogy about her garage door and her roof and planning ahead and knowing that she's set that money aside and that she won't be putting it on a credit card. Knowing that when you do put something on credit card, and I think Jillian and I talk a lot about this, that when you see a great deal on a pair of jeans and you buy them for $50, but you put it on a credit card, and those jeans now cost you $68, they really weren't that great of a deal. So establishing a positive credit history, having some funds set aside for those purchases, looking ahead will save you money in the long term. Reducing your stress and helping you to use money as a tool to do the things that you want to do in life. So taking that vacation and putting it on a credit card, and you come home and your tan has faded, but the credit card bill comes and you don't have a tan, but you've got a credit card bill. And that can reduce the stress that you kissed goodbye while you were on vacation, and add it back into your life when you see that. So planning ahead and using credit wisely will help you reduce your stress over the long term. And this is part of our mission here at Morgan Franklin Fellowship, is that we like to help people feel in control of their finances and providing them a sense of financial freedom. So establishing that positive credit history allows you to feel that sense of financial freedom by allowing you to know that you really are in control of your personal finances. Jillian, anything before we wrap up today?
No, I don't think so. I think we've kind of covered it all. We wanted to share with you why it's important to know what your credit score is. how to find your credit report, and why we need to have emergency funds and how that comes together. Because here at Morgan Franklin Fellowship, like Tori was saying, we really believe that money is a tool. And as you can see from this slide, that, our focus is on how to teach people to save, invest, and grow their money. And we tried to do this through our Standards of Financial Literacy program, which is our signature program. We have had hundreds of people come through and learn the rules and the vocabulary around money, finance, and banking. This curriculum is based on the standards of financial literacy that were developed by the Council for Economic Education. This curriculum is a free curriculum to go through, and we hope that you will take advantage of this. And upon successful completion of the Standards of Financial Literacy program, you also have access to other courses and opportunities like mentoring, networking, potential internships, and all of these opportunities are available to our fellows. And you can become a Morgan Franklin Fellow by just completing the Standards of Financial Literacy. So we hope that this has been helpful to you, and you can see our website there, morganfranklinfellowship.com. Click on this, go visit us, see what we have, read our blogs about our fellows and what our fellows are doing. Take a look at our courses. We always have new courses that are being added throughout the year. And we hope that you'll come back at another time and join us on a webinar, learning how to make money a tool that works for you.